Hi, Joe Lepresti here with the Arlington Wealth Management Proactive Strategy Update for Friday, November 3rd. Well, the markets went through a pretty vicious 3-month correction starting in August into September, culminating in October. Going into that period, our tactical indicators were positioned at high levels, and we speculated that if the market was going to correct this year, it would be in that August-September time period. That stretched well into October this year too. Along that way, as the markets corrected, those same tactical indicators went full course and hit their low risk and oversold levels. That could start to set up a tactical buy opportunity, and that could line up with what tends to be a stronger period in the market seasonality-wise between now and year end, and even stretch into the early part of 2024. So let's take a look at our PAS dashboard. And what we could see is there's been some movement within our core indicators, namely the long-term momentum, which is a month-end indicator at the end of October, did switch from positive to neutral. So we're going to take a look at that indicator. The cash comparison charts, however, actually improved from negative back into neutral status. So there is some moving around within these indicators in terms of their status, but none of that has changed. The major market cycle is still bullish as of that buy signal that's going back about 11 months now. During the correction that we just went through and could be at an end, we've seen some pretty good action in the market this week that kind of a reflex rally back to the upside that could indicate the correction's over. But as the market corrected, the universe trend indicator turned to negative status. Now, what we're seeing some very interesting action is in these tactical indicators. The last update, we saw a low risk reading here. We saw an oversold and even very oversold reading with this indicator. Those have now come out of those deep low levels and back into a more neutral type of position. So we could start to see the pendulum swing in the other direction, in a more positive direction. So here's our long-term momentum indicator for the global stock index, which is the Morgan Stanley MSCI All Country World Index. And you can see the 3-month correction there, pretty steep give back of some of the gains from the earlier part of the year. And the status is now officially neutral. Neutral is indicated by the white background, as you could see, happens periodically as markets are cycling with this indicator. We tend to see it in one of two instances. Right? The first instance is when the market's topping. So if we go to later part of 2021, as the market was beginning to hit its peak, we see the momentum start to fade and it goes from positive to neutral and eventually into a negative status. And that's a market topping pattern. And what we really notice during those times is recoveries during these corrections tend to be weak, and the internal strength of the market starts to roll over. And then when the market begins to decline from one of those recovery attempts, that's when we could get a negative type of status. So we'll be on the lookout for that, indicating that this was the ultimate high, and some recoveries that might follow, which we think could develop in just the next few months. The strength of those recoveries is going to be important. And of course, those are things we'll be talking about in future updates. The other time we see neutral is during a hesitation or correction in an ongoing uptrend like we saw here in 2020, and you just see frequently during bull cycles. We saw one, in fact, earlier this year when the market was correcting, and so now we have our second neutral reading in this uptrending, longer-term uptrending market. Now let's flip to looking at our tactical indicators. And what we saw was a high reading at the end of July when the markets hit their peak, and we moved well into that low risk zone during October. Oftentimes when we get that reading, it's setting up a potential buying opportunity that could be at least short-term in nature and sometimes then extends into more meaningful periods. Last year around the same time set up a similar type of buying opportunity. So we view the market condition as getting into a better place right now than we saw in the last 3 months. A lot of that short-term risk that we saw in the market when these indicators were at their highs has been worked off, and that could set up a good opportunity in the market as we approach the end of the year. And although a much different indicator, generally speaking, kind of following a similar track where we were at the high overbought level at the end of July. We spoke about that at the time. We went through what seems to be like a three-legged correction with the first leg, second leg, third leg, got us well into the oversold zone. In fact, even a little bit out of the channel there temporarily. And now we're seeing a snapback that's brought us back into the channel, but still, near the lower end of the channel. Oftentimes, the last leg down in a correction is unwound very quickly if we see a short covering period. And that's what we think happened this week, is that we saw a lot of short covering develop in the market, which brings some demand in for stocks. And now we'll see if the short covering rally can take on a life of its own. And if that happens, our model is set up now for a potential tactical buy signal, one that we call a mini buy signal. We're not quite there yet, but that could develop very quickly. And of course, we'll keep you apprised of that if it happens in between updates with a flash alert. That tactical buy signal could also line up with better seasonal tendencies between now and the end of the year, and even extending into the early part of 2024. We're out of that weaker period and now into the seasonal strength. Another variable that often comes into play in these market movements is investor psychology. This is the U.S. Investor Sentiment Survey by the American Association of Individual Investors, their bull-bear spread. We look at this regularly because what we tend to see is that investors are positive at highs, negative at bottoms. Positive at highs, negative at bottoms. So if we just look at the last couple of years, before the bear market started, at the beginning of 2022, investors were very positive, more bulls than bears. As the market went through 3 consecutive down quarters last year in a bear trend, investors got very negative, more bears than bulls. And then when the market recovered, just going into that July high, we got back to a pretty high level by the measure of this survey. And that set up a drop in the market. And we got a 3-month drop, and now those same investors are very negative. So, individual investors are a good contrary indicator. When they're positive, generally it's not a good time to buy and more likely a time to sell. You use it in a contrary nature. And when they're negative, it sets up a buying opportunity because, negative investors have already sold. That supply is reflected in stock prices. And then it doesn't take a lot of demand to turn, swing the pendulum back in the other direction. Sometimes, like I mentioned earlier, some short covering by, hedge funds or institutional type of investors that might sell short. That demand comes in and starts to lift stock prices up. And then maybe some favorable news develops and a market trend develops and gets a life of its own. So that's our glass half full outlook, where tactically now indicators have worked off all the excess risk that we saw in the market going back a few months ago. Investors have moved from being optimistic to pessimistic, and we're through that seasonal weakness and now into the seasonal strength in the market. All this is potentially lining up a buy signal with our market model. And should that happen, it could develop very quickly if the market doesn't take another leg down first. And if that happens, we'll be taking some action. But we also have a glass half empty outlook as well. And that is Still, our economic modeling is warning of a recession. And the second area that we're watching closely still is our 210-day indicator. Flashed that warning about a month ago, remains in a troubling position. So we're watching both of those, and let's take a quick look to update you in each of those areas. So we'll start off with looking at the 210-day indicator. And the alarm came during the correction. In July, August, September, October, we saw a big drop in this indicator. It typically doesn't move this fast, and when it does, it's something to pay attention to. And really the specific action is the drop below 50%. In previous cycles, when this indicator drops below 50%, we tend to get a lot of negative action in the market. And of course, when that happened at the early part of October, it was ahead of what turned out to be a pretty negative October. Things seem to be stabilizing a bit now, but the negative action in this indicator has not been reversed yet. So we continue to have some concerns here. Again, a drop below 50%. We tend to see a lot of volatility in the market between that point and whatever the ultimate low is. The low doesn't tend to be at the 40% range. It tends to be in the 20% range. So we'll continue to monitor that and keep open the possibility that a year-end rally could get called off because of this weaker breadth that we're seeing develop from a global perspective. And the other area, and perhaps even more meaningful area, is the recession models continuing to suggest that we will experience a recession. We're seeing the monthly leading index here, which is now updated through the end of September. And the red line, which is the leading monthly index, hit a new low for the cycle. So had a little bit of recovery there for a few months, and now is basically back down to the low, technically at the low point for this cycle. The long leading index hit its low a few months ago and is improving, but that's very typical. I've had some clients ask, when is the recession going to happen, or is it too far beyond the point when this model warned of a recession? And the answer is absolutely not. If we go back to just the last meaningful recession here in 2008, the long leading indicator flashed the warning as early as August of 2005. So that was more than 2 years before the market peaked and close to 2.5 years before the recession. Now, the red or leading index tends to move a little bit quicker. In other words, the recession occurs more shortly following the warning from that indicator. So by that measure, we're a little bit longer into this cycle when the recession hasn't developed as when we would expect it. But by no means are we beyond the point when this model's predictability has exhausted this recession call. So if we turn to looking at a few of the specific economic data points that is part of the model, you can see U.S. housing starts recovered a bit in the last month, but off of their low. The high came, I think it was April of last year. So that drop in housing starts is a meaningful impact on the economy. M1 money supply growth continues to deteriorate. Putting that in longer term perspective, you could see really probably the biggest drop in money supply that we've seen on this chart. Other times, just leveling off of the money supply growth can cause recessions. Now, that is just reversing the massive amounts of increase in money supply that we saw during and well after the pandemic. The yield curve is still inverted. The Fed funds rate is above the 10-year Treasury rate. You can see the 10-year Treasury rate had been moving up for a while. This week it dropped a fair amount. But the point is that we have short-term rates above long-term rates. Why is that important? Well, because generally speaking, when that happens, a recession occurs. Yellow above purple, recession. Yellow above purple, recession. Yellow above purple. So we have it now. it's suggesting a recession will develop. And finally, I want to look at the unemployment rate, which actually just came out today. So, we have October's data. It won't be reflected in our economic model until next month, because that model is updated with all of September data. But something we believe important happened, and that is we got an increase in the unemployment rate, which is now 0.5% above the low for the cycle. And the significance of that is there's never not been a recession when the unemployment rate goes up 0.5% from the cycle low. So once again, you could generally see unemployment rate starts to rise and there's a recession. And now we have the unemployment rate rising once again. So that's the glass half empty argument, right? That there still are some longer term or intermediate term concerns, although that could get offset with the short term, the tactical opportunity, the seasonality that's developing, and really oversold condition that hit the markets there right at the end of October. So how do we intend to move forward is if our market model does provide us with a tactical buy signal, which could develop very quick unless the markets take another turn down first, we will move in that direction, and we'll do two things. One is some of the additional cash that we moved to the sidelines when the 210-day warning flashed in early October, that helped cushion the downside during October, but we could move that money back into the market to be more flexible and dynamic and try to take advantage of the opportunities that may be developing on a shorter term basis into the stronger seasonality. The second thing is we'll reallocate current positions into new asset classes that our models and indicators are suggesting are beginning to lead this rebound and recovery into the market, and that seasonal strength that could develop into the end of the year. Well, that's going to wrap up this update. Thanks for watching, and if anything important happens in between updates, we'll be notifying you with a flash alert. Have a great weekend.